Welcome to The Explainer. You know, long before Warren Buffett was a household name, he was a young guy in Omaha writing these incredibly detailed letters to a small group of partners. So today, we're going to crack open his letters from 1965 to find the very blueprint that built the legend. Okay, so let's just dive right in. This is the scorecard Buffett showed his partners in early 1965. And just look at these numbers. For 8 years, the Dow did pretty well, right? Up 131%. But his partners, they were up over 400%. I mean, that's not just beating the market, that's a whole other stratosphere. And here's where it gets really, really interesting. Compounding it over 22% a year, yeah, he was doubling the Dow. But look at that third bar. He was more than doubling the returns of the 4 biggest, most respected investment funds of the time. We're talking about the giants of Wall Street, managing billions. And they couldn't even keep up with the index, let alone some 34-year-old from Omaha. So this huge gap in performance, it led Buffett to ask this one big fundamental question that would really define his entire career. Why were the smartest people with all the resources failing so badly? And his conclusion was, pretty powerful. He realized it wasn't about a lack of brains, it was about the institution itself. He saw this machine that was just built for mediocrity. It was fueled by groupthink, this deep, deep need to look like everybody else, and a system where just being average was safe and having an original thought was actually risky. So he built his partnership to be the exact opposite of that. So here's the crucial point. His entire edge came from redefining one single word: conservative. For Wall Street, being conservative just meant owning the same big, popular, blue-chip stocks everyone else owned, no matter the price. For Buffett, no. True conservatism had nothing to do with being popular. It was an intellectual process. It was about facts, and it was about sound reasoning. And here's the proof in the pudding, right? He said, let's put it to the test. How do you do when the market goes down? Well, in the 3 years the market fell, the Dow and the big funds lost about 20% of their value. Buffett's partners, they were up 45%. That, he said, was the result of a truly conservative strategy, protecting your money when it matters most. His whole philosophy really boiled down to this one simple but, really profound idea. Safety doesn't come from following the crowd. It comes from doing your own thinking. Period. Okay, so that's the philosophy. But how did he actually do it? What was the playbook? Well, he broke his whole operation down into 4 distinct categories, what we can think of as his 4 engines of return. All right, engine number 1, General's private owner. This is the classic stuff you probably think of when you hear value investing. He was looking for companies that were trading for way, way less than what a smart business person would pay for the whole thing. The key here is the mindset. You've got to think like an owner, not like a stock trader. Engine 2 was a little different. This was for the bigger fish, the larger companies, where that private owner idea didn't really work. Here he was looking for obvious mispricings, buying a company that was just flat out cheap compared to its direct competitors. It was much more of a statistical, relative value game. Now, Engine 3, the workouts, this is where things get really interesting. These investments had almost nothing to do with the market's mood swings. They were all about predictable corporate events. A merger, a spinoff, something that was already announced. I love his analogy here. He said it was like looking for parking meters with some time left on them. Just free money waiting for you. And then there's the final engine, and the most powerful one, controls. Now these were rare. They usually grew out of his private owner investments. See, if a cheap stock stayed cheap for long enough, he could just keep buying it until he owned enough to actually take control. And at that point, who cares what the market thinks? The value is determined by the business itself. And you might be thinking, okay, that's a nice theory. But no, this was happening in real time. In his mid-year letter of 1965, Buffett told his partners that he'd done exactly this. He'd taken one of his undervalued holdings and turned it into a control situation. And what was that company? Well, it was a little struggling New England textile mill that he'd bought as a statistically cheap stock. You might have heard of it, Berkshire Hathaway. The control engine was fired up, and it became the foundation for everything that came next. But look, this strategy was just one part of the blueprint. The other half, and maybe the most important half, was all about psychology. And it started with his really contrarian view on taxes. He basically said that obsessing over taxes is one of the biggest mistakes an investor can make.
His logic was just dead simple. Don't let the tax tail wag the investment dog. The goal isn't to pay zero taxes. The goal is to end up with the most money after taxes. So if selling a huge winner and paying the tax lets you buy an even better opportunity, you do it every single time. It's just math.
And he had the receipts to back this up. He pointed to these things called swap funds, which were set up specifically to help rich people avoid capital gains taxes. And as you can see, by focusing on taxes instead of on good investments, their returns were, well, they were just pathetic. Okay, the last piece of this mindset puzzle, and it's a big one, was his almost fanatical belief in the incredible power of patience and time. And he didn't use a stock chart to explain it. He used a story from 1626. He tells this classic story about the sale of Manhattan Island, where Native Americans supposedly sold the whole island for goods worth about, get this, $24. Sounds like the worst deal in history, right? But Buffett, being Buffett, he asks a different question. What if they had just taken that $24 and invested it at a pretty reasonable rate for the next 338 years? That $24 would have turned into more than $42 billion. A number that, as Buffett loved to point out, was worth way more than the entire island of Manhattan was at the time. The real power wasn't in the real estate. It was in the compounding. So when you put it all together, what do you have? You see that this 1965 blueprint, it was so much more than just a stock-picking guide. It was a whole operating system built on independent thought, on thinking like a business owner, on strategic flexibility, and, maybe most of all, on mastering your own psychology. And that really leaves us with one big question, doesn't it? In our crazy world of high-speed trading and constant noise, could it be that this simple, patient, business-first approach from 60 years ago is actually the most radical and valuable idea of all?